figured we could use some light music considering today's topic, which is estimating your taxable income when converting from GAAP basis to cash basis for your tax return. So, this template is meant to help you understand that process. I highly recommend you consult your tax accountant or CPA to help verify that this is being done properly. I am not a tax preparer. I don't do returns. However, I do calculate tax liabilities for financial statement purposes, which is a rough estimate of what the client is likely to owe. So, this is by no means an exact science. This is to give you some idea of what to expect. Again, I highly recommend you consult with your tax CPA. So what we're doing here is taking your GAAP basis income and converting it into cash basis income. And what I want to do is go over an example here using the template, which you can find on the website www.thewhipreport.com. I'll include a link to the website somewhere on the video or in the description so you can download it and check it out for yourself. But high level overview, we are trying to unwind GAAP income and convert it into cash income. What that means is going from a system where you recognize revenues when earned and costs when incurred, regardless of when cash was moving, to a system that recognizes revenues when cash is received and recognizes costs when cash is dispersed. So, totally different way of recognizing revenue and expenses. That's the purpose of this conversion here. So, the first thing you do is get to your book income for the current year, which we'll say for this example, fake number, $10,000. Now, what we're going to do to this $10,000 of net income is we're going to add back some balances and reduce some balances to get to that cash basis net income. Essentially, the difference between cash received and cash paid out. So, in this example here, just assume your book income is $10,000. Well, you're well aware of that. That book income is not all just doesn't just incorporate the cash received. You may have, billed out either for service jobs or for your construction jobs. You have some items in your accounts receivable. Well, what is accounts receivable? It's not cash. It just means that your customer owes you the money. So that IOU is not cash. So we have to reduce the amount of income we recognize by the amount of accounts receivable in the current year, assuming that this accounts receivable is strictly related to the services we provide, whether it be construction services, warranty, those types of items. So making up a fake number, assuming it's $1,000. We billed the clients in the current year or prior years, the sum is $1,000. We are reducing our income by $10,000. Okay? Now, on the other side is the accounts receivable from the prior year. So let's assume it's 2,000. You see here that this is a positive number. The net effect that's going on here is $1,000. Okay? If I'm highlighting, you see the sum right here. $1,000. We are adding $1,000 to your book income. So you can imagine you go from $2,000 in accounts receivable to $1,000. all other things equal, straightforward example, we're assuming we received $1,000 in cash. Well, that receipt of $1,000 in cash, which is, you debit cash and you credit receivables, that's increasing your cash income, right? So we we are adding back $1,000, and you can see from book income to this tax income is an addition of $1,000. So at that point, we are adding to our book income for the difference in accounts receivable. And again, the reason why we subtract current year is because we want to carve out any of the activity in the current year and add back what we didn't take credit for in the prior year. Similarly, with accounts payable, your subcontractor invoices, your supplier material invoices will need to be factored in as well, because this goes into your cost. All of the costs associated with this final book income here is on the GAAP basis, meaning you incurred those costs, but you may not have necessarily paid cash for it. It's just hanging out in accounts payable. You owe your subcontractor $200. That cash hasn't moved, so you can't take credit for it. And by take credit for it, I mean you can't reduce your income for it. So assume in the current year your accounts payable is $400. That $400 is an addition to the book income. We are adding back that $400, saying you can't take credit for it because we're looking for transactions that relate to the movement of cash. So you type in $400 and boom, that takes your book income up by $400. But we have to factor in the prior year accounts receivable. Again, entering in whole numbers, assume it's $300. That's reducing your income there. So we go from 11,400 to 11,100. Now, the difference here is $100. Again, similar to the accounts receivable, this is just a liability. We find the net to be $100. That's the difference. That's the difference we're going to add back to the income. Last year, we couldn't take credit for this accounts payable because obviously the cash had not moved last year. So we had to add it back, just like as we're adding it back this year. And we're reducing it this year, which tells us, again, all things equal, that the net impact to our taxable income is an addition of $100. We're saying that the activity between the prior year and current year results in adding back $100. So on our example so far, we've added $1,100 based off of this conversion. Now let's move to under billings and over billings. In this book income, you have your under billings. You debit the underbilling and credit revenue, right, as the offsetting entry. So included in this book income is your GAAP basis revenue recognition, which we want to undo. So assuming your underbillings in the current year are $100, you see we're reducing taxable income because all we want is cash basis. Now, similar to the other examples, there's the prior year effect as well. So we will say for this purpose, it's $75. We're adding back the prior year underbillings. We're adding those back because if you follow that logic, what you underbilled last year, you're going to bill out this year. And so what you're left with in the end with your underbillings is an overall reduction of $25. Similarly, with your overbillings reduce your income up here. That's a reduction. So what we want to do is add that back. So assuming your underbillings are $80 in the current year, we're adding that back to this book income because ultimately it was reducing it. You come here to the prior year effect and assume $90 was the overbilling in the prior period. That's a reduction. With a net impact of $10 affecting your taxable income. Now, prepaids like your prepaid insurance is typically the main balance related to the prepaid line item. Current year cash was transacted, right? On GAAP basis, that's an asset. You haven't incurred the cost. You've paid for it, but you're going to receive some future benefit from it, so you can't recognize that expense. So assuming your prepaids are $15, that's a reduction to the book income, which this is one of the easiest ones to comprehend. That's a reduction to book income because cash was transacted. You paid cash for it. That's an expense according to cash basis. But you have to factor in the prior year as well. Assuming it was $20 in the prior period, you already took credit for this in the prior period, so you're undoing that credit. And by credit, I mean you already took that as a reduction to income. So that net impact there is $5. Now let's move to depreciation on a GAAP basis, typically straight line. Let's assume the depreciation for the current year is $100. Tax depreciation on an accelerated method, MAKERS, or whatever your tax accountant has calculated, that may be including bonus depreciation. It's typically higher than your book depreciation. Let's assume for our example it's 175. We're adding back the depreciation book because that's what was reducing income to this 10,000 amount, and we're reducing our book income by 175 because we're converting depreciation to tax basis depreciation. So that's a quick overview of how to convert GAAP basis income to cash basis for the purpose of estimating your cash basis taxable income. I know that's a lot of information thrown at you in a short amount of time, but understanding it from the pure concept level will help make this make sense in terms of why we're adding and subtracting balances in the current year and why we're adding and subtracting balances from the prior year. All we want to do is capture the change between these accounts, which all things equal should reflect the movement of cash from accounts receivable, meaning these are outstanding balances that your customer hasn't paid for. You're not going to take credit for that when you're doing cash basis income. Obviously, you haven't received that cash. With accounts payable, you're not going to take credit for that expense because you haven't paid cash for it in the current year. So again, you look at the prior year, the exact opposite is going on. You're taking credit or you're increasing revenue of accounts receivable from the prior year because you're likely to have received that cash in the prior year. You didn't receive it last year, It was a receivable, but now it came due and your customer paid for it. Cash basis, you recognize that income, so it's an addition. And the same with accounts payable. You paid those open invoices, which resulted in a reduction of cash and should have resulted in a reduction in income, which you see here. And the same concept works for under and over billings. Under billings here, we're reducing the book income because we're not allowed to recognize income from under billings. That's not cash basis. So we have to subtract that out because it was increasing our income here. We don't want to take credit for anything for which cash hasn't been transacted for. Over billings we're adding here because that means we've billed ahead. It's either living in accounts receivable or we've received the cash. That over billing is reducing this book income, so we have to add it back. We want to neutralize, if you will, that effect. And so the exact opposite, as you can tell, for every positive here, there's a negative here. It's offsetting it. We're adding back the prior year under billings because you would turn around and bill your customer in the current year. Chances are you would have received the cash for those billings. And in overbillings, we took credit for it in the prior year. We want to undo that recognition when calculating the current year effect. And the depreciation here, which is one of the more easier concepts at play to convert from GAAP to cash basis. So I hope that all made sense. If it doesn't, drop a comment in the comment section and I'd be very happy to explain it further. Thanks again for tuning in, and I'll see you in the next lesson.